And Markowitz's modern portfolio theory is a way to control the risk. And that's what the most of the optimization is done. So the portfolios we have seen right now are most of them were heuristic portfolios. So they haven't used the covariance. They were only looking at the past historical return. And then they were trying to then allocate the weight either to single stock or maybe multiple stocks. But in general cases, we want to minimize the risk. And in this case, in finance, we want to maximize the expected return, which is similar to the average benefit maximization. So we try to get as much as return as possible. But at the same time, we have another aim. We want to also minimize the variance or the covariance multiplied by the weights, which is the risk of this portfolio. And again, risk is basically by the covariance matrix. So we have V transpose, W transpose, covariance matrix times W. This is the variance of the portfolio, and it's also known as the risk. In some cases, volatility, which is basically square root of this, is also known as the risk. And again, most basic measure of risk is given by variance. So in general, a higher variance means there are large peaks in the distribution, which may cause the large loss. So for instance, if the returns are like stable, then the basically variance of such returns will be, this is the return graph. So this is over time t, and the y-axis is returns. So this is quite stable. In this case, since returns are quite stable, they don't deviate much from the mean, then the risk of this portfolio is lower. But for instance, if we have a portfolio which returns higher, but on the other hand, lower, so it's high, low, it kind of fluctuates between high return and low, it has a high return potential. Okay, that's correct. Even though it has a high return potential, on the other hand, it has basically a high risk because it has a high variance. So in this case, we need to balance both of these two. So there are other risk measures as well. So for instance, another like the VAR or the variance is one of them. We have downside risk, which is basically shows the risk of the portfolio or whenever the variance is less than the mean. So this is semi-variance. So it's variance. We'll see this in this class. So it's semi-variance. And the variance where there is only loss. So for instance, if the portfolio is going, if the return is higher than the mean, then we don't consider this as part of the risk because we don't lose much. So in this case, we come up with an asymmetric measure of variance. When this case, when variance only greater than, where variance is calculated only less than mean return. And this is known as downside risk. And again, value as risk and expected shortfall are two other risk measures. And again, risk controls the average performance, not the average performance, but the probability of going bankrupt. And in this case, we try to basically balance both the mean return and as well as the basically minimize the variance. And again, in this case, we have a mean variance portfolio where basically we try to maximize the return, the mean return, and maximize the variance or the risk of the portfolio. And again, in some cases, variance is used. In some cases, volatility, which is the standard deviation, or which is the square root of this variance, is used. And those are the two functions that we want to use. And in general, the higher mean return means a higher variance. And in this case, there are kind of contrastive objectives. So we try to maximize the return, but on the other hand, lower the variance. So this kind of becomes a multi-objective optimization problem. And in this case, the solution is not a single point because we have two objectives to be optimized. One is maximize the return, the other is minimize the variance. We have a mean variance trade-off curve, which is kind of a Pareto optimal curve. And again, our optimal solution here will depend on basically how risk averse we are in our selection of this portfolio. So for different portfolios, so inside this curve is a feasible point. So on the x-axis, we have the standard deviation, of the portfolio, the standard deviation of the portfolio. And on the y-axis, we have the expected return of this portfolio. And in this case, what we want to do here is we want to basically minimize the standard deviation, which is the risk. And on the other hand, we want to maximize the expected return. And in this case, there are many portfolios that satisfies this. So for instance, in this case, this curve, Pareto optimal curve, these are the portfolios that basically maximizes the expected return and minimize the standard deviation. So all these curve here, that's like there's a parabola here as a result of this optimization. This shows the mean variance trade-off, and it's known as efficient frontier. So in finance, this is known as efficient frontier, and it's all the solutions that give us a high expected return and low standard deviation. And among them, depending on how we define a single objective, so there are many ways to define single objective, we'll come up with single points. And all the points inside these efficient frontiers are feasible portfolios, meaning that they can be selected as a meaningful portfolios. But the exterior of these curve defines basically the efficient frontier, which are the efficient portfolios in terms of maximizing the return and minimizing the standard deviation. And in this case, if we look into the portfolios, there are certain portfolios. If we try to maximize the Sharpe ratio, which is basically the ratio of the expected return minus the risk-free rate divided by the volatility of the portfolio, we have seen this. There is some point here. Or in other words, we may want to just try to minimize the variance without interested in the return minimization. Then there will be a global minimum variance portfolio, which is here. Again, it's the leftmost point in the x-axis for this curve, which minimizes the standard deviation. And however, if for maximum Sharpe portfolio, it comes to some point here, we are trading off some of the standard deviation, but on the other hand, we are going up in the y direction, and our expected return is kind of increasing. And inside these points are all feasible portfolios. So this shows the mean variance trade-off. Again, it's basically by selecting certain single metric correspond to the expected return and the standard deviation, we are just selecting a single point among these efficient frontiers, which are all the efficient solutions. So if you look at Markowitz mean variance portfolio, it's the trade-off between the mean variance portfolio, which goes back to the early 1950s, but it's one of the most commonly used methods. It's one of the traditional methods in portfolio optimization. Again, the idea here is that finding a trade-off between the expected return and the risk of the portfolio measured by the variance. Here, instead of volatility, we are using the variance. And we try to maximize, as you see in this objective function. So this is convex. And in this case, we have quadratic terms in the objective function. So in this case, W, the weights of the portfolio are unknown. But we know that the weights of the portfolio will be add up to 1, because this is one of the requirements. And in this case, we try to maximize the weight, expected weights. So this is a linear constraint. As you see here, this is a linear constraint. And we try to minimize the variance. In this case, we have a lambda term. Lambda is a trade-off term. So this controls the trade-off and control how risk-averse the investor is. So lambda values will change depending on how the risk-averse or the risk-taking the investors is. So this is kind of the modern portfolio theory. We have, again, this expression and this W transpose times covariance matrix times W is quadratic. So as you notice, this is quadratic. And in this case, we have a single linear constraint. And one thing about these convex optimization problem is that this expression, so WT times mean minus the weighted variance matrix is as a single solution. So we don't need to solve the optimization problem. It admits a closed form solution. And the closed form solution here is as follows. So again, you don't need to memorize this. So if in an exam, probably this will be given to you. So you don't need to memorize any of them. But taking the derivative, we can basically, taking the derivative, we can prove that this is the optimal solution. Yes, there is a hand. Eren, you can ask question.
Hocam, in this case, first we select the stocks or assets. After that, we use the optimization problem, right? We
Yes.
cannot use the optimization problem for the selecting the assets. We cannot use it. We can just, in this case, just decision variable is this weight. Weight means that this is the coefficient of the assets. So we first select the stocks or assets, then we optimize the portfolio, we distribute the weight, right?
That's correct. That's correct. So you first determine your universe, and then from your asset universe, you calculated the expected mean and the covariance matrix for your universe. Then you select the W's, which are the weights.
But we can extend this formulation, and we added in a new decision variable for selecting the stocks. So we can use another combinatorial optimization problem for one to select the stocks and decide to weight, right?
That's correct.
But
correct.
It's an harder to solve it.
That's correct. If you select the single asset problem, then it will be probably an L1, L0 norm constraint, and probably it will be an NP-hard problem, and that will be harder to solve. But again, one thing, go on, another question.
But if we select like a whole universe, a lot of assets, and if the weight is decided to be 0, then it means that we don't select that asset.
That's correct. That's another thing. Thanks. Again, this is a great remark. I was going to say that. So one thing is basically you can select the whole universe as your asset set, and then you basically run this optimization. And if it's assigned a 0, which won't be assigned 0, depending on the problem, it will probably assign a smaller weight, but some weight. Then you basically select some of them, the ones with the 0, as the ones that are not included in the universe. That will also be possible.
But in this case, we can lots of variables, right? Redundant variables.
Yes, there will be a lot of redundant variables, and depending on how this convex optimization is defined, there will be always some weights, some small weights assigned to every variable. That's why in this case, you may need to do some rounding. You may say that if the weight is smaller than something, then I won't invest in that stock.
Yeah, we create the same variables for all stocks, all assets for weights.
That's correct. That's correct. And this is convex problem with one linear constraint. And again, in this case, basically, another alternative formulations are possible. So in this case, one alternative formalization is if you know that you want to control your variance, if you know that you want to make 10% variance, assuming you just made up your mind and you said, okay, my portfolio variance should be less than alpha, then it will be basically an easy problem. Then there won't be any lambda. So the lambda here, the trade-off between these in the previous equation. So let me go back to previous equation. Lambda will go into as a form of alpha here. And again, another thing is minimization of the risk. So in this case, we can minimize the risk, assuming that we want to expect a return higher than beta. So we think that basically we want our return to be more than beta, then we can just minimize the covariance and add this return should be greater than beta as a constraint. And in this case, again, these are all similar formulations. So again, by sweeping over different parameters, so different lambdas. So if we select different lambda and solve for the problem, then we can basically come up with the result in the Pareto optimal curve. So for instance, this efficient frontier, which is the Pareto optimal curve, are for different lambda values. So for instance, if one point corresponds to lambda equal to 1, another point will correspond to lambda equal to 2. So in this case, by changing the different lambda values, we come up with different values in this efficient frontier. And again, there might be some other constraints in general Markowitz portfolio. So for instance, in Markowitz portfolio, we write this as in this form, where we have the lambda that controls the trade-off. And then the budget is equal to 1. We can say that we do not allow shorting. So in this case, we can show that our portfolio weights should only be long. They should be greater than 0. This is one thing. And this constraint is basically linear. So again, this problem will be convex. You can solve it in any convex optimizer. And again, leverage is less than gamma. So again, we can say that this is also a linear constraint. So we don't need to add all of them. We can add subset of them. And we can assume that we have an initial portfolio, W0, and we want to make a turnover constraint. So we want to make the buy and sell limited by some turnover value. Again, this is a convex constraint. And again, the maximum position in the portfolio may also be limited. So for instance, we can hold for one stock at most 50% of that stock. So that will be also a max position constraint. And that will be also a linear and convex constraint. And however, L0 norm here, so for instance, we may want to only select K assets. So given N assets in the universe, we want to come up with solution that's in which case there are only K variables are non-zero. So this is non-convex. So ensuring the sparsity in the optimization problem without rounding is non-convex. And all of the constraints, others are convex, and that won't make the problem more complicated. And again, without the sparsity constraint, the problem can be written as a quadratic problem, quadratic programming problem, because the objective function is quadratic programming and the quadratic objective function, and all constraints are linear. That's why the problem will be a quadratic programming problem. So let me try some examples. So I will add some Jupyter notebooks as well to the web page. So from now on, so today we have gone a lot over the optimization, but there are basically a bunch of notebooks that exist and that will gone over related to what we did. So in the first case, we can, there's a notebook about estimation of these covariance matrices. So here we have basically a direct covariance matrix, which is historical value. So the normal covariance matrix is basically expectation of the formula that you know, x minus expectation of x times y minus expectation of y. And in this case, this becomes the covariance matrix. And in this case, what we do here is we are defining an sample covariance matrix. Again, I will upload these codes and for simple variable. And we are also calculating another variables called y, and we are calculating their covariance matrix. And in this case, basically, what we do here is we have two variables, x and y, and we try to find the best fit, best line fit for these lines in the linear equation. And in covariance matrix, assume that we have this start and matrices. We have 4 assets for now, and we get the prices for these 4 assets by using this get pricing method. And the 4 assets are the ones here, SBUs, Apple, GS, and GLID. And we are using the first month, January, of this variable for in sample. And by getting these returns of these assets, we are calculating the covariance matrices of these assets. And again, in this case, these are the covariances, and see how the covariance changes from different types of matrices. And another thing about these covariance matrices, which we have not gone over in the text, is shrinkage estimators. So the shrinkage estimators are, in general, this covariance matrix depends on the historical data, and it's not that stable. And in order to make it stable, there are certain estimators called shrinkage estimators. What we do is, if we are given a sample covariance matrix S, then what happens is that if we have the mean variance of these returns, basically here is the mu, and then we define a shrinkage constant such that we basically take 1 over epsilon times S, and the remaining part from the basically the mean variance. And in this case, we basically define a new covariance matrix, which tends to be more stable. And we use this more stable covariance matrix in our portfolio optimization in Python. And one such estimator is, again, we're not going in detail, is Ledoit-Wolfe estimator. And Ledoit-Wolfe estimator is where this parameter is selected. And this parameter in the main equation is basically related to the trace of the covariance matrix. This is the trace of the covariance matrix. And this has been shown to be performed quite good in the practice. That's why we have this Ledoit-Wolfe estimator in order to shrink the covariance matrix. Trace of covariance matrix divides on number of samples that we have where we estimate the covariance matrix. So assuming that we estimate the covariance matrix on t time points, then this is the Ledoit-Wolfe estimator. And here we'll compare the covariance matrix with the Ledoit-Wolfe estimator. And again, for the same period, for different symbols, we get their returns as well. And here are their returns. And we calculate in sample their Ledoit-Wolfe covariance matrix. And this Ledoit-Wolfe covariance matrix is different than the other covariance matrix. And what we do here is basically, since we calculate basically the covariance matrix, then what we do here is from the auto return period, we calculate auto sample period, which is the February of 2016, whereas in sample period was the January of 2016. We calculate again the matrices, both the original matrix and as well as the Ledoit-Wolfe matrix. And what we do here is we basically compare the values, compare the two matrices values individually, and plot as a box plot. So in this case, if you notice that the errors are lower, so the sample estimate covariance matrix, in sample estimate covariance matrix, the difference between in sample and the out sample covariance matrix is smaller when we use Ledoit-Wolfe estimator. So the error is smaller than the one that we compare in sample covariance matrix with the out sample covariance matrix directly. And that's why the Ledoit-Wolfe estimator here gave us basically a smaller error. And that's why it's more stable. And in some portfolio optimizations, we do not directly use the covariance matrix, but we use the Ledoit-Wolfe estimator instead. So this is one notebook, and another example here is Markowitz portfolio theory. So in Markowitz portfolio theory, again, what we do here is we basically select different returns of 4 assets. We create the returns of 4 assets. And then what we do here is we create different portfolios with random weights. So we create 4 assets with random portfolios over 1,000 observations. So it's mostly like if you assume daily, it's like a 3-4 year period. And then we randomly calculate the portfolios. And here for 500 random portfolios for given return vectors, we plot how the portfolio return and standard deviation looks like. And this is basically mean return and standard deviation of the returns of randomly generated portfolios. And as you noticed here is basically efficient frontier. So the returns that are in the outer domain in this parabola are efficient frontiers. So in this case, depending on whether we are coming up with the global minimum, so global minimum variance portfolio will be the one that will give us the lowest standard deviation. Whereas, for instance, again, so max Sharpe ratio will give us some balance between the expected return and expected standard deviation. So this is how we basically generate randomly in this notebook. We randomly generate basically the efficient frontier for different portfolios. So here is basically an optimization library. So there is a library called, I will add some references called CVX opt, which is CVX-opt and CVX-Pi. These are the libraries that you can use to optimize a certain things. They can optimize quadratic methods, linear methods, so they are quite efficient. So you can take a look. In these example, we have this Markowitz optimization. We have this basically the difference between the returns and the covariance. And in this case, we are creating basically some matrices, constraint matrices, when the portfolio weight should be equal to 1, and they should be greater than 1. And in this case, we are basically optimizing by using these solvers.qp, which is a solver for a quadratic optimization problem. You can take a look into this example. And again, in this case, by using the returns of the assets and the covariance matrix, we are finding an optimal portfolio. And again, the portfolio that we find correspond to the yellow dots in this optimality case. So again, here we are running this for different weights. And that's why for different weights, we are getting different portfolios. And these portfolios correspond to the ones on the upper side of this parabola. So for each desired return, we fixing the return, we solve the problem, and then we come up with an optimal standard deviation portfolio. And again, here's an example on the real data set. For different tickers, we get the market data for different data sets. And again, this is in the notebook. And then by using the Zipline API, which is another library you can download and try to play. And in the Zipline API, by using the covariance optimization, and we see basically by using this price, we use a covariance optimization, and then we come up with an efficient portfolio that will perform as in this plot, as you see here. So the plot here is, just a sec, it's been here. So this is, we start with basically 100,000 US dollars. And if we simulate this portfolio, if we always use Markowitz portfolio or this trading strategy, we make our money in this case with these stocks that we considered, just 6 stocks, we make it 600,000. So it's almost more than, it's almost like a 500% increase over these years. And this is another sample notebook, and that I will upload. So I think we are up today. So in next week, we'll continue with the portfolio optimization. Again, we'll see different types of portfolios. And again, we'll see different examples in Python notebook, how these these can be coded and can be optimized so that you can also use this portfolio optimization in real time, such as if you are in crypto exchange or if you have assets, you can definitely use these portfolios to come up with an efficient portfolio. So thanks for listening and thanks for attending today. Have a nice day and see you guys on next week.